Welcome to Home Ownership Education 101, brought to you by themortgagereel.com, and I'm Keith Akada, your host for today. How credit risk pricing from Fannie Mae and Freddie Mac increased the cost of financing, just released in January 2011. In this example, we use a purchase price of $350,000, a borrower that has a 700 FICO score with 20% down. Can you believe, yes, a 700 credit score has a 1% add-on. Now we're going to make this very clear here shortly and explain this, but a 1% add-on is what is now factored in. What you're viewing right now is the actual risk-based pricing adjustments from both Fannie Mae and Freddie Mac. On the left side, you'll see the credit score tiers. On the right and through the top, you're going to see the adjustments and your down payment range. So in this model, with a 700 FICO score and a 20% down payment, we have circled in red the actual 1% pricing adjustment. Now we'll begin to explain and clarify further on how this is going to appear in your closing cost estimates. This example demonstrates that it's now going to cost a borrower $2,800 more in closing cost or factor into a higher interest rate. Let's also use the exact same scenario with the borrower that has an 800 credit score and find out how this is going to impact the same scenario. Now, someone with an 800 FICO score now also has to factor in with the 20% down payment a 0.25% add-on. We'll clarify this more. As you see here, again, looking at a 740 FICO score in your top left, anything higher than that, now up to an 800 with a 20% down payment, you now have the 0.25% pricing adjustment, which we've circled in red. Now we're going to dig into how this is actually going to come out as far as hard dollar. So for a borrower with an 800 FICO score, this is now additional $700 in closing cost or a higher interest rate. Now stop right here. I know everyone viewing this clip is thinking, Keith, this is crazy. Why would I pay these higher costs and why? Really, it comes down to Freddie Mac and Fannie Mae coming out with what they feel is their risk-based pricing. Unfortunately, it was supposed to reward the higher FICO scores and penalize the less, but it's now penalizing everyone. But wait, before frustration kicks in, there are still options available. It doesn't always have to be paid out of pocket or an interest rate. Let's view further. For the two examples we just provided, we are now going to provide real-time financing options available in today's market. Here's option 1, paying close attention to the lower interest rate and higher closing costs. Because of the 1% risk-based pricing adjustment, there's now a discount point of 1% equaling $2,800. The interest rate itself at 4.625%, APR at 4.859%, you will overall see the impact on closing costs has been increased from $5,940 paying the additional discount point of $2,800, totaling $8,740. Now with this option, this specifically points out if you want to keep the lower interest rate over taking a higher interest rate. Now we go to option 2, which does point another way, where if you don't want to pay the high closing costs, you could factor it in another way. Now here in real-time financing option 2, you're going to notice the higher interest rate and lower closing costs. Now here in this example, you'll notice that there's only a loan origination fee over having to pay the additional 1% discount point. However, the interest rate has moved higher from 4.625 to 4.875 with an APR of 5.022, overall impacting the reduced closing cost at $5,940. What we've just demonstrated is in a way to have an option in financing in today's market. By increasing the interest rate, we've eliminated the discount point, overall decreasing the amount of closing costs that you will have to bring to the table. Some borrowers will still like the fact of having the lower interest rate, however, it may cost them more money out of pocket. The main points that we wanted to bring out here, it's not the lenders that are incurring these costs or taking on these fees as a profit. It's being incurred by Fannie Mae and Freddie Mac. Clarifying the differences between the two financing options. If you elected for the higher interest rate, it would cost you $42.19 more a month. If you elected for the lower interest rate, it would cost an additional $2,800 in discount points. Both of these, using the same example, have having a closing cost base of $5,940. So we can see clearly now that credit score, yes, is going to be a driving decision maker on what your financing structure is going to look like. But keeping in mind, this is not compensation that's going to the loan originator. This is a fee that's incurred directly and distributed by Fannie Mae and Freddie Mac. We hope you enjoyed today's education clip from Team Mortgage Reel. But our main goal is to make sure that everyone, including future and current homeowners, understand that housing is still affordable in today's market and financing options are still out there. But bottom line, education and transparency is our team commitment. We want to make sure that the Team Mortgage Reel continues to put this out there for all current and future homeowners to view. If you're looking for a mortgage professional in today's market, we'd like to ask, how can we assist you? Feedback and comments are so valuable to current and future homeowners that continue to visit the website. We ask you, if you found anything interesting or valuable in today's tutorial, to please leave comments below. You can also find Team Mortgage Reel on Facebook at How to Beat the Banks. Also, if you enjoyed today's clip, make sure to find us on Facebook and like us. We'd extremely appreciate your like and thumbs up.